Yeah, good morning all, and welcome to, I think it's our fifth in the room webinar with Innate. Just waiting for one more presenter to join us. There she goes. Okay, cool. So thanks. First of all, thanks to the audience and the participants for joining us. I know everyone's quite hectic, and it's tough to balance kind of the work-life balance at the moment. So we really do appreciate your time and joining us. So first of all, just a quick intro to Charles and Pallavi. So today I'm talking to Charles de Kock and Pallavi Ambekar from Coronation, who I'm sure are quite familiar faces to most of you, or at least you've heard their names. And they are the co-managers of the income and growth solutions at Coronation. And they manage the Coronation Capital Plus and Balanced Defensive portfolios. So welcome, Charles and Pallavi. Thanks for joining us. Before we kick off, just a couple of, as always, kind of house rules, if you like. So we try and make these sessions as interactive as possible. So it's not kind of the fund managers just presenting and talking back to you, but I'll ask a bunch of questions. But it'd be great if you can also ask questions. You can do that via the Q&A tab, which is kind of bottom of your toolbar for Zoom, and type up your questions in there, and we'll happily try and get to them. One thing I'm going to try and do slightly differently today that I've done in the past is probably going to have a chat for about 20-25 minutes with Charles and Pallavi, and then have a pause, and then get into the questions, and then carry on, and then towards the end do the same with the questions. Okay, some of the feedback we've got in the past is it can be quite disruptive with the questions, but we really do want to hear from you, so please type them up. The webinar is a 1 hour webinar. We will finish at 10:30. I won't go over, again, just in respect for your time. And obviously very important is the CPD process. So it's changed slightly from some of our previous webinars. If you attend basically the full hour, so from 9:30-ish till 10:30, then you automatically get one CPD point. If for whatever reason you need to jump off, or you join late, and I'll obviously reiterate this at the end for the people who do join late, then I think you complete an assessment for your CPD point. Likewise, if you are sitting with some colleagues watching this and you haven't registered yourself, then you'll have to complete the question, the assessment to get the CPD point. Cool. Okay. So then we can get going then. So yeah, it's great to have you Charles and Pallavi. I see Charles is at home, like myself, and I think most of us. But Pallavi, it's nice to see that you're in the office. Things hopefully slowly returning to normal a little bit. So it's good to see that. So the first question actually is from my side. Is that you two manage what traditionally are called absolute return funds or portfolios, and I see now, I mean, actually you guys refer to them as more like income and growth strategies. Pallavi, what's your thinking around this?
Thank you, Steve, for that introduction. And yeah, just from my side, welcome to everybody on this webinar. As you mentioned, I am in the office, and things are slowly returning to normal, as you said, but we still pretty much only 10 to 15% of people in the office on any given day. So managing to work pretty successfully from home for most people at Coronation. Just a brief introduction on the absolute return funds. There are two funds, the Coronation Balanced Defensive Fund and the Coronation Capital Plus Fund, and they have a dual mandate. So their mandate is to provide a return. In Balanced Defensive's case, it will be an inflation +3 targeted return, and in Capital Plus an inflation +4 targeted return. These are low risk solutions, so the other mandate, other than the return mandate, is to try and aim for capital protection. For balanced defensive, the capital protection aim is over the rolling 12 months. And for Capital Plus, it would be for rolling 18 months. So the dual mandate in terms of a return, which is pretty much a limited return of inflation plus, versus, and as well keeping an eye on the downside protection and looking to aim for capital protection.
Okay. So, I mean, it's interesting you say that, because it was, so one of the questions we posted the invite on LinkedIn, and I said, anyone want some questions? Shout if they asked me to ask a question. And one of the questions I got back was around performance. And so it's obviously quite a hot topic. And you look at the volatility that we've gone through over the last little while, particularly kind of your downturns in kind of March, April, and then the bounce back kind of since then. And then that coupled with kind of quite low returns, and especially kind of you're not really getting real returns for a period of time, except for maybe 2019. And you guys had probably one of your worst performance periods over the last little while. I mean, do you want to? I mean, either Pallavi or Charles, do you want to? Can you address that?
Yes.
Yeah, I think so. Sorry, Charles, you go ahead, or
goes for Charles.
My turn.
Okay, go for it, Charles.
Yeah, it's clearly the last number of years the returns have been generally on the low side. If you look at what's happened to SA equity, property, it's been hammered massively. So cash has actually done better than those areas now for 5 years. So you haven't been rewarded for taking risk in the SA market for some time now. When culminated in March this year with a massive sell-off across the asset classes. So bonds got hammered up to about the 25th of March. I think bonds have done even worse than equities as the market totally collapsed. So you had just at the end of March, it was just an all fall down case. It's sort of a very scary experience to go through when all your asset classes that you invest in left at the same time. Because global equities went down, SA equities went down, property got massively slaughtered, and our bonds as well. So the only thing that gave you some protection was cash. And with the benefit of hindsight, we didn't have enough cash. But come April, May, June, we've had a pretty sharp recovery. So Capital Plus, I think for the quarter up to last night, it's up 11.5%, and balanced defensive just over 10%. So you've had a very good bounce back. And you could only do that if you don't go to cash at the so I think you must stick to your risk strategy. One of the foundations of the lower risk funds that we've always followed is to diversify. So to have not all your eggs in one basket. We still think that's the correct strategy, because sometimes, even if you have high conviction on a asset class, you can get it wrong. We know there's one asset manager, say, who thought property was going to be the best asset because of the high income yield, etc. We know what happened to them. So we think putting all your eggs in one basket is a dangerous strategy, because high conviction can also be wrong. So we do keep a spread of assets, and within the various asset classes, we diversify there as well. For example, in the bonds, we don't only have long-dated government bonds. We'll have floating rate stock, we have ILBs, and we have lots of corporate debt. Unfortunately, what happened in March is all those assets just collapsed at the same time. So you had one horrific experience at the end of March. We write our quarterly reports and we rotate. Sometimes I write them and sometimes Pallavi writes them, and she had to write them at the end of March, and I could wash my hands because it was a horrific story to write. And I'm writing them tomorrow. And it will be a far better story to write, because we're going to have super returns and the bounce back. So it's a much nicer story to be able to tell. But that's why it's so important for clients not to look at a short-term return, because the markets do tend to bounce back, and we've had a pretty decent recovery there.
It's interesting. I mean, we were chatting yesterday, and I mean, it's spot on. It just shows that unfortunately there are a lot of headlines. It's short-term news as such. It's dramatic. That's what unfortunately headlines do at the moment. They are dramatic. It's bad news, and unfortunately people react badly to it. I say badly, but emotionally to it. And Pallavi, you and I were chatting yesterday around the flows going into kind of cash and fixed interest over the last little while, and unfortunately, then people who are sitting in cash and fixed interest have now missed the bounce back over the last couple of months. Which again, I mean, it comes up time and time again. But you know, we got to, if you're in a portfolio for a particular reason, you got to stick to your guns and your strategy.
So I completely agree. I think that, you know, as sharp as that sell-off was in March, and as much as our returns didn't come through as we would have liked to come through, there were also many attractive valuation opportunities in the depths of the crisis. And I think one of the advantages of Coronation's investment philosophy is that we are very much valuation driven. We do have a long-term focus. It does help us to some extent put the short-term noise aside and look at the hard numbers and the hard multiples and the hard yields that are on offer. And if they're attractive enough, we have to be unemotional and take advantage of those opportunities. And a great example there, one of the reasons why, for example, Balanced Defensive and Capital Plus went into negative territory into March in the depths of the crisis was simply because our fixed income portion didn't perform as we had expected it to. Charles mentioned that. But, you know, when South African government bonds were yielding 12%, that was a very attractive investment opportunity. So we took that opportunity. We increased our fixed income allocation. And as you can see, that's come through very nicely for us in the last quarter. The yields have come all the way back to, say, 9.1%. And that's provided the returns that the strong bounce back, or added to that strong bounce back we saw in the last quarter. So I think the combination of not panicking at the bottom, being able to be very rational about what the attractive opportunities are and taking advantage of them is one of the things that you'll have to continue doing in the future, given that there's still a lot of uncertainty around. And hopefully we get more of those opportunities. Other thing I wanted to mention is that in the slide pack that you'll see that gets sent out, is often after these periods of extreme drawdowns, there's actually quite a big bounce back in returns from a number of the risk asset classes, especially in the next 12 months. So it's often a good time to actually increase your risk exposure as valuation levels have reset. And usually the subsequent 12 months to a big drawdown period usually provides you with very good returns.
So, I mean, can you give us some examples of where you potentially see some opportunities? Pallavi, I want to stick with you because you're talking about it. So again, in those risk assets, yeah.
Okay. So I think firstly, let's talk about SA equity. For the last 3 to 5 years, SA equity performance has struggled to beat inflation. But within the SA equity component, the global rand hedge shares have provided a very good buffer against poor returns. So within our SA equity asset allocation, we've been pretty cautious on domestic SA stocks for a very long time now. The bulk of our exposure has been to these global rand hedge shares. So when you look at our top 10, you'll see the Naspers, the British American Tobacco, Mondi, Quilter, and those have all come through very nicely in our SA equity allocation. And it's about 70% of that SA equity is to these global rand hedge shares. But within domestic SA equity, we are starting to see some very attractive opportunities. Now, you might question the timing because I don't think we are very optimistic on SA's growth prospects. But even with that negative outlook on SA's economic prospects, I think there are certain businesses that will be resilient, that will have the ability to grow market share and actually deliver fairly good returns for shareholders. So in our carve out, I think 3 specific ones that I'd like to talk about are First Rand, Spar, and Dis-Chem. And we can talk a little bit more in detail if you like, or we can move on to something else if you want.
I think it might be good time to bring Charles in as well. I mean, I talk about Spar's a retailer. We talk about retailers. The general word in the street with retailers is retailers have been smashed unless you're kind of in the e-commerce space. But then you mentioned a Spar, and I got a Spar, and I mentioned, I think, our last webinar, Spar down the road. And it's always busy, but cheap. Even in the beginning of lockdown, you went to that Spar any time of the day, and it was pumping. So Charles, I mean, can you talk to us around the kind of the opportunity you see from the likes of the Spar?
Yeah, we own Spar. We also own ShopRite. We have a little bit of Pick and Pay, because the FMCG retailers, I mean, they sell necessities. They don't sell nice to haves. And clearly they weren't affected by lockdown, other than in the case of Spar, where Tops and Build It, of course, they were closed, and Tops is a higher margin business than the rest of Spar. So, that would have hurt them a little bit. But they also, in other countries, I think it must be 7-8 years ago that they bought the Spar franchises in Ireland, and that's done very, very well. And they've subsequently also bought in Switzerland and in Poland recently. So you do get some rand diversification as well, because they're not only in one geography. But that franchise model is a very defensive model, because the franchisee takes some of the risk on himself, so that the corporate doesn't carry all the risk. But it's a very deliberate strategy to own some of those defensive retailers, the FMCG ones. They may not shoot the lights out, but as we've seen in this pandemic, just how defensive they are. They're the ones who keep the doors open. And always in mind to managing inflation, they tend to be able to, keep prices going up a little bit. So you tend to find that they're a good inflation hedge. Whereas if you're selling, motor cars or furniture or something, you may not be able to pass price increases through. So the defensive ones, I think Pally can mention Dis-Chem specifically. She's the analyst on Dis-Chem. That's another one of the very truly defensive businesses.
Yeah, so Pally, then straight into it. I'd love to hear your thoughts on Dis-Chem.
Yeah, sure. So on Dis-Chem, I mean, another business that was allowed to trade despite lockdown. So once again, the resilience of the model coming through, because as they sell what was classified as essential goods. But just even without that, trading during that lockdown period, they will still be relatively defensive even as we come out of lockdown and as the economy normalizes. Not only are they selling healthcare items which people need every day, but they are also, both Dis-Chem and Clicks, taking share from the independent pharmacies. So they have a natural growth runway, whereas many other South African businesses are actually very mature. I think the other thing we like about Dis-Chem and Spar is that their balance sheets are very strong. So they are able to use their balance sheets to take advantage of the crisis. And we've already seen Dis-Chem come out with an announcement that they would like to buy Baby City. Now, my kids are a bit older, but I recall going to the Baby Cities about 10 years ago. And I mean, it's overwhelming, the product range. I mean, I didn't know you could get 30 different types of bottles to feed a child. But, I think it's just a natural extension of a category that Dis-Chem is already in, a space that Dis-Chem is already in. I think it makes about 850 million rand of revenues. Those revenues will come onto the base business model at a pretty healthy margin. And Dis-Chem has invested a lot in their supply chain over the last few years. So, just backfilling that supply chain, once again, just gives them that natural boost to their profits without having in our opinion at least, having overpaid for the business. So they've once again used the crisis. They've done a very good deal. We think it will be value accretive, and they haven't stretched their balance sheet to to extraordinary levels. They might pass a dividend, but that's okay. They might raise a little bit of capital, but once again, that's okay as long as that deal they're doing is adding to the returns for shareholders.
Okay. Yeah. So I've also got a baby city down the road. Also, I spent some time there. Not cheap, I must tell you. So yeah. So a question that's come through from the audience is, and it is saying, so what's the prospect of SA equities as well? So I think we've spoken a bit about that, but maybe a bit broader. But a question I had, as well as SA property, given the pure SA economic environment. So I think it's a really good question. Charles, can I give that to you?
Yeah, for the property sector specifically, they've really experienced the perfect storm. First, let's say they had a golden period behind them. They had a long period of space growth and escalations in rental agreements and so on. Then came the Eskom load shedding stuff that we've now forgotten about because we've got a bigger crisis to deal with. But the load shedding really hurt them badly. So they were already suffering from that. And now the pandemic came and the lockdown. And suddenly, when really strong tenants like the Fushinis and so on of the world tell the landlords, we're not paying you for rental for 3 months, the landlord can do nothing about it, really, because there's not like there's somebody they can put in Fushini's place into their shopping malls. There's nobody to take the place. So really had it tough. I think the valuations were also somewhat stretched, and the balance sheets also got a little bit stretched because property companies tend to pay out 100% of their earnings, and this LTV, the loan value ratio, and as the valuations now come lower because the property space that used to give you so much rental income now gives you less because some of the clients aren't trading and they closed, and the ones that are trading far lower, and they can't afford the rental agreements that they signed initially. So then those valuations come down and the loan to value goes up. And the banks start getting fidgety because they lent money to them, and there's a covenant that says the LTV can't be more than 50% or 45% or whatever it is. And as that then drops below that ratio, then the banks get fidgety, and now the companies are likely, most of the listed REITs are going to pass dividends. It's a huge chunk out of the valuation of a property company because you buy property for that yield, and if they're going to pass dividends, and some will pass dividends for 2 years, others for 1 year, and some will get by without passing it. As soon as the property company doesn't give you a yield anymore, the valuation becomes really problematic. So although property stocks have sold off massively, have not added. We've looked at that space and our valuation models, and there is just such a sort of perfect storm for them that we find better value in other places. So property as a percentage of our portfolio is sort of 2 to 3% of total portfolio now. It's very low. It's the lowest it's been in my time, but we're actually not adding.
And I suppose, I mean, you talk about the perfect storm that's passed. I mean, the kind of the COVID pandemic hasn't helped either, and it's not going to help going forward because again, something we've spoken about a lot in the past and on these shows before is that again companies like ourselves are potentially realizing that you don't need these big offices. So you actually can actually have a lot smaller offices with hot desks and things like that. And again, there'll be pressure in the system going forward.
I think
almost everywhere. If I could just quickly say, almost everywhere in the property space you're having trouble. It's not just the shopping malls. As you mentioned, it's offices as well. And then if you really want to get into the eye of the storm, it's the leisure space, hospitality, hotels, casinos, that sort of a thing.
Yeah.
Gyms, they still closed and going to be closed for quite some time. So if you own a hotel somewhere, the only thing you can do currently is to, make some beds available for people in quarantine and hope the government pays you. But and that's going to take a long time to recover. I think e-commerce and so on was already taking bigger market share, and this experience will just accelerate it. I mean, we're on Zoom today, sometimes I'm on MS Teams, and sometimes I'm on Blue Jeans, and those are three things I didn't know existed 3 months ago. And so I think office, retail, hospitality, all in trouble. Yeah,
absolutely. Pallavi, you want to add anything to that?
No, I just wanted to maybe just emphasize that, as Charles has mentioned, this COVID pandemic has brought forward some structural changes in the office space. Offsetting that might be, there's increased, requirements for social distancing, might help the office space, ironically, in some ways, because if you are going to bring people into the office, you can't have them sitting as close to each other as they were before. But nevertheless, overwhelmingly, I think more structural headwinds for the property sector. Online in SA hasn't really taken off to the extent that it has globally. So we are far behind in terms of online retail penetration. But if you look at, some of the advances we're seeing coming out of this COVID pandemic, the Woolies has started to introduce click and collect. It's not, you can have groceries delivered to your home. Pretty much all these clothing retailers are starting to push their e-commerce strategies. Those are all things that will take shoppers' time outside of retail malls. We're already overspaced. The likes of Edcon, we can see, is already reaching bankruptcy. Those vacancies have been penciled in, but there will be other retailers that will not survive this pandemic. So I think we should expect further vacancy pressures over and above just Edcon. It will be the likes of Dion Wired from the Massmart stable. And just generally, I think retailers, with the pressure they're seeing on their sales, are going to start shrinking their store sizes and shrinking their store footprint. So those all take the demand for space away in the property sector. And then you compound that with pressure on escalations, rental reversions, and then you just have top line that doesn't grow, and you have very deeply leveraged capital structures. I think there just needs to be a reset in the whole property industry first, and we haven't yet reached that point.
Yeah, it's quite depressing, but also it's interesting. It's very real, and you talk about like a Dion Wired, and again, why go to Dion Wired when you can buy something online? You can buy from Takealot or even a Credit Connection, they do online deliveries and that. So I'll just do some more questions here. So a couple have come through, which I don't want to miss. So first of all, is what other diversifying asset classes do you deploy in your funds? Do you have gold, anything else? And I know that you did some structuring earlier in the year. So maybe just in terms of the diversification story. Pallavi, you want to take that one?
Sure. So other than the mainstream asset classes that we have exposure to, we do try and protect, buy protection in terms of puts or hedging where the prices are quite attractive. So within the SA equity exposure, about 20% of our SA equity exposure we have put protection against. This is pretty much usually a standard level of protection that we have. We will raise that protection or lower that protection if we think markets are looking very expensive or very cheap. And also if the pricing is attractive. At the moment, we're sitting at about 20% protection of SA equity, specifically for Capital Plus. And that's really because Capital Plus has the higher SA equity exposure. Balanced Defensive has much lower SA equity exposure. We have in the past bought S&P puts. We do have some S&P puts in place currently, but just before the March crash, I think we got quite lucky. We did buy some S&P puts at very attractive levels, and we did that simply because we thought the market wasn't pricing in these COVID risks. And the timing of it was quite good. It wasn't in enough size to provide a complete buffer, but nevertheless, we did buy some S&P puts. We do have an exposure to gold, just over 1%, say 1.5% exposure to gold, and as well as about another % plus in platinum. And those are just ETF exposures. I think gold always provides some sort of at least some sort of hedging quality in the portfolio. Potentially might increase our gold going forward, not right now at the moment, but if prices come back to reasonable levels, we might increase our gold exposure.
Okay, cool. And then thanks for that. And then another question. So Charles, I'll give this one to you. Please unpack your fixed interest carve-outs in your funds a bit more. Not a large increase in risk, and with regards to longer dated govies.
Okay, well, there is a decent slide in the pack on that. I'm just going to look on my screen where I can find that, because I can give you exact detail.
Then while you're looking, so just remember, everyone, we will be sending the slide pack out in the thank you mailer. So what Charles is talking to you now, I'm hoping will be in the slide pack.
Yeah, it will be in the slide pack. Cool. It's if we take the interest-bearing component of balance defensive, for example, that's 47% of the portfolio is in interest-bearing. Of that, 16% is in fixed-rate government bonds. Then we have a small sort of 1% in inflation-linked government bonds, and the rest is in corporates, either inflation-linked corporates or floating rate corporates or fixed rate corporates. So the bottom line is the all bond index has a modified duration of 6.4, and our modified duration is 4.1. Now, what does that mean? It means if the yield curve kicks up by a full 100 points, then on the all bond index, you will lose 6% of capital. We will lose only 4%. The all bond index has a yield of 9.5. Our yield is 9.2. So we have somewhat lower yield, but not materially lower, because in the corporates, you get the yield pickup there. And so we're very comfortable that we're not taking too much risk in the bond space. But there is some risk, as we saw, because we have a modified duration of more than one. And you only get that duration if you go somewhat longer on the yield curve. So we have a diversified portfolio of corporates, governments, inflation linkers, and floaters in there. Just most recently, what we've done, Pallavi mentioned that we added some govies in that big sell-off in March. But since then, as the yields have pulled back materially, we've actually been lowering our duration. So we've trimmed a bit on the bonds, but within the bonds, we've just shortened the duration a bit. And the reason for that is the fiscal situation is looking so dire that we just don't want to own too many SA government bonds. We've seen many countries, emerging countries, often get into trouble. Mostly the ones that get into trouble will be the countries like Argentina, gets into trouble every couple of years. And why they get into the trouble is because they tend to issue dollar-denominated government bonds. And because they can't dollars or tax dollars, then they don't earn enough exporting stuff out of Argentina to earn the dollars to pay the debt, and then they renege on the debt. Now, in SA's case, we have a very low issuance of dollar-denominated debt, mostly SA rand-denominated debt, and as long as government can tax and print money, they should be able to pay you back. But both those things are problematic. The one is the printing of money will possibly, if that happens in a big way, we have numerous examples of that around the world. Venezuela and Zimbabwe come to mind very, very quickly, and other countries as well. So big inflation risk. That's why we do like to own some ILBs in the portfolio as well. Now, of course, there's pressure on the Reserve Bank. They are standing very firm not to get down the road of printing money to get to pay the debt, but there will be pressure. And as yields are pretty high, the government sits in what we call a debt trap. Their debt servicing cost is going to, out of every 100 rand that the government gets in revenue, they're going to have to spend something like 21 rand of that just servicing the existing debt. And that becomes quite problematic because they need to spend money on lots of other areas as well. And as that becomes a big problem, it also crowds out the private sector in terms of their demands for money. So that's why the real yields are now actually pretty high. And I think, frankly, going to stay pretty high because there is such a huge issuance of stocks of the government, because their revenues are running way behind budget, like 300 billion behind budget. Now, where are they going to get the money from? So they have to issue bonds to get the money in to do that. So there's a huge supply of bonds in the market. They're issuing more bonds every week. And what happens? Too much supply. Doesn't work well for the price. The price goes down, the yield goes up. So that's why we are taking some risk off the table. We still think it's a reasonably attractive part of the market, but less attractive than we thought pre-COVID because of this blowout in the fiscal affairs of government.
So another question is for me is that, I mean, so you say you've got a whole bunch of corporate debt, which then obviously gives you potentially a nicer yield. We've also spoke about balance sheets. So obviously, I mean, the risk with the corporate debt is that it's, if the corporate goes under, then it's. So I mean, I'm presuming you're comfortable with those corporates there and the risk that they potentially bring into the portfolio or don't. Pallavi?
I think what works well at Coronation is that the equity team works very closely with our fixed income team. So when our fixed income team looks at any particular corporate credit, they often sit with the equity analyst, go through the debt metrics and the balance sheets in quite thorough detail. So it's not just with one hat that we look at a corporate, it's quite a holistic view of the corporate. And so, where the debt is in a corporate where we think there is potential risk, we will either demand a higher price, so we'll either look for a higher spread before participating in that corporate credit, or we will avoid it if we don't think the pricing is attractive. And I think, we have actually passed up quite a lot of opportunities over the last couple of months simply because we don't think the credit spreads were attractive enough. The ones that we hold in the fund, we've had no issues with in terms of their credit quality. And so, I think we are, and in particular for these funds, looking very much at the downside risk. And if we think there's downside risk in the equity, then it's highly unlikely that we'll hold the corporate credit.
You don't want another African bank scenario as an example. So another again, we spoke about, we talk about the property, the property sector. We spoke about kind of, probably about banks, and banks started getting a bit nervous and itchy. I mean, what is again, looking at the current scenario, is it appears, with just consumer debt potentially on the rise, potentially some corporate defaults potentially coming through. Does that put pressure on the banks? And what is your view on the banks, Pallavi?
So the banks have been one within the SA equity space, especially in the domestic space, have been probably one of the sectors that has derated quite significantly. We do have exposure to 3 of the SA banks, so FirstRand, Standard Bank and Nedbank. Our biggest exposure, and you'll see it in our top 10 holdings, is to FirstRand. And the reason we like something like FirstRand is that even when we price in the impact of this COVID year on results, and it won't be pretty. For all the banks, I think you should expect pretty much very muted advances growth, big spikes up in credit loss ratios. Even even with that, I think these businesses will be pretty resilient. They're all the ones that we have exposure to. We're quite comfortable with their capital ratios. You know that the Reserve Bank has asked all the banks to pass dividends for this year. We've put that into our valuations. But I think they come out of this pretty still functioning. Still, they will not need to raise capital. And even if they pass a dividend for 1 year, unlike the property companies, we think there's potential for a catch-up dividend in future or outer years to come back to shareholders. So if you look at the banks from a 3 to 5 year time horizon, the franchises that we invested in, we think will be pretty resilient. FirstRand has led the way in terms of digital products offered to consumers. So we talked about e-commerce in the retail space. I think FirstRand has been very quick to get customers into online banking, put the systems behind, the e-bucks system, which I'm pretty sure many people participate in. It's quite a good reward scheme. So they've been very active on the digital front, and I think that's the way banking is moving. So FirstRand in particular, we think will be at the very least be able to defend its market share, if not grow its market share over the next 3 to 5 years. And given their capital structure, we think they're least at risk of raising capital.
Cool. Yeah. Again, I think you make such a good point. I think we spoke about it earlier. Is that again, we've got to take. We often get stuck in that short-term view, and you've got to take the longer-term view. I mean, when we chatted yesterday, is that as bad as this seems out, this too will pass. That's the reality of it, and opportunities will come out of this environment. And there'll be some structural changes, yes, but the opportunities will come out of it, and the companies and businesses that are positioned well and strong balance sheets will actually potentially gain market share. And obviously, FirstRand, in your view, is one of those. So another question just from the listeners' audience. Charles, this one's for you, and I had it on my list to ask you as well. Is Marius Fenwick asks it. What is your view on Tito's budget speech last week? And I think you felt it was a little bit weak. And does it impact your positioning of your portfolio?
Yes, the supplementary budget was necessary because the February budget is totally irrelevant because of whatever they projected to raise in revenue and so on. It's just gone out the window with a lockdown period. So you had to come up with a supplementary budget. It was a bit light in detail, so it promises a few reasonable things. There were some nice words in there saying that they aim to get to a primary surplus by 23-24 that year. The primary surplus means that you have current expenditure lower than current revenue. Now, for households, that makes an awful lot of sense. You don't go and borrow money to buy the groceries. That would be wrong. You can borrow money to go and add on a second story on your house or build a swimming pool or something that's of a capital expenditure nature. But the government has been running a primary deficit, which means that we're actually borrowing money for current expenditure. That's salaries and wages and stuff like that. So at least they now acknowledge that, we shouldn't be there. It's pretty stupid to be there in the first place, but they have been there for many years. So now at least there's a cabinet commitment, we believe, that the whole cabinet has agreed that they will work towards this primary surplus by 2023. It's nice that they say that, and it's wonderful that cabinet acknowledges that. But to get there, my problem is they'll have to take a huge knife to government expenditure. And the proof over the last number of years, many, many years, is that they're not able to do that. So I'm a little cynical that they will be able to cut expenditure to the extent needed.
And if they wanted to cut expenditure, I mean, where could they cut it? I mean, is it, the biggest portion of expenditure is government employees, isn't it?
Yes, exactly. It's more than 50%. More than 50% of all government expenditure goes on wages. If I said earlier, 21 Rand out of every 100 Rand will go to servicing debt. Another something like 53 Rand of every 100 Rand goes to paying civil servants. Then there's not a ton left. And you need to spend money on schools and infrastructure and all kinds of defense and all kinds of things like that. So I'm not too hopeful that they will actually get there. But if they don't, we are in serious trouble. And they acknowledge that. They showed that what he called the passive scenario, saying if we do nothing, then the debt to GDP goes to 140%, and then you're a basket case. The active scenario, they want to stabilize the debt to GDP, bring it back to sort of like 87% or something like that. Very laudable aim. If they can do that, fantastic. Then I think the bonds at the current yields are okay. But I'm a little bit careful that what the Minister of Finance says, I don't know that all his cabinet colleagues are really committed to being as prudent with their expenditure as that. And we've seen all over the world, politicians like to make promises and spend money. That's what brings the voters in. Hiking taxes and spending less and giving you lower salaries is a very unpopular thing. Politicians hate doing unpopular things, but they don't have a choice here. Yeah.
So then, talking about politicians, and okay, slightly left field, I'll just quickly bring in, and I'm always fascinated by is the US elections coming up in what? It's in November, and also we got Trump, who just loves to tweet, and they're random and they're aggressive and whatever you like. And then there's, as he calls him, Sleepy Joe. So I mean, what's at the moment the polls, and again you know, the polls are saying Joe Biden's probably the front runner, but I think last election Hillary Clinton was the front runner, and we know what happened. Does the outcome of, and Pallavi, I'm asking you this one, does the outcome of the US election impact your investment decisions and your portfolio positioning? So, for example, I give is I remember when Cyril was potentially hopefully going to win the ANC electoral conference, and again it was you had to almost go an NDZ or a Cyril, and you had to have a view on one of those because the impact would be quite big on our economy. The same thing is if Joe Biden wins or if Donald wins, does that impact your investment decisions? Looking at that.
So the short answer is no. Right now, as we sit in the portfolios, we are below the maximum of our offshore exposure. So if you think about the impact of potential impact of a change in presidency, where it would have the first most immediate impact, it would be in your offshore allocation. And within that offshore allocation of say 25-26%, for balanced defense of about 15% is in global equities, and for Capital Plus it's a little bit higher at 20% in global equities. Most of that exposure is diversified across a number of fund managers. The main product that we're invested in is the Coronation Global Fund of Funds. There's about 8 fund managers underlying that. They're very much, similar kind of long-term valuation-driven investment philosophy. So, whereas an election outcome might drive some headlines, I think it would, in the shorter term at least, not really impact the underlying holdings or the valuations of the holdings of those investment managers. But nevertheless, if we look at the different types of policies that might come into play with a Democratic president such as Joe Biden, if he comes into the presidency, I think versus a Donald Trump, a lot less spontaneous, I would expect, and probably a lot more considered in terms of his international policy. So one thing we've seen under the Trump administration is a lot of resetting of international relationships, a lot of throwing out of previously held agreements. We've seen the trade tensions with China escalate. So actually, maybe from that perspective, a Democratic president might calm the waters a little bit from international trade, international relationships perspective. However, from a US perspective, I think what we're all likely to see is a Democratic president probably come in with a lot more regulation. I think it's fair to say under Trump administration, businesses have had free rein in terms of, running their businesses in full corporate mode without any hindrance or obstacles put in their place from Trump. I remember when he was elected, one of the first things he did was remove any regulations that took longer than, say, 2 weeks or a month to get through. I mean, he sped up approvals and permitting, etc., and that made it easier to do business in America. And I think the Democrats might reverse some of that ease of doing business. The energy industry, the oil industry under Trump has had a lot of support and protection. Under Joe Biden, I think that's unlikely to have the same sort of protections. There might be more of an environmental focus from the Democrats, which sort of starts to put requirements on the energy industry, which they didn't have before. So I think the shorter term impact on US businesses and their ease of doing business, you might see a lot more obstacles in their way under a Democratic president. But just in terms of our portfolio positioning, I think we try to choose businesses, that are fairly resilient to these short-term shocks and these short-term changes. So we're not going to be changing anything on the back of a change in presidency.
Cool. Charles, you add, yeah? Yeah.
And that is, financial markets like predictability. Even if you disagree with a fellow's policies, at least if you can foresee what he or she is going to do, the market can price for that. The Trump presidency has been extremely unpredictable. He's really turned things upside down, and the financial markets have accordingly responded to that. Frankly, I think a second term for Mr. Trump, a final sort of 4 years, I think he could become totally unhinged and even more unpredictable. So from my own selfish point of view, I think that sort of, governing by midnight tweets or something is dreadful and makes the markets more volatile and just less predictable. I think a Biden fellow will be far more predictable in terms of policy.
Yeah, no, you make a good point. You do kind of wake up in the morning and wonder what he's tweeted, don't you? So just before we kind of move on to kind of some final thoughts and closing is, again, we spoke about kind of a lot of flows going to fixed interest and cash. We also know that, cash is what going to give us 4%, maybe a bit less than 4% going forward. So, again, it does speak to, it's like, Pallavi, what is your view on cash? Because it's what we're getting, 7% kind of last year. So hopefully, maybe 4%. It starts having quite a big impact on kind of real return from not you ever get from cash, but an impact in kind of safe havens in cash, because you're not really getting much out of it.
No, and I think this is quite an important inflection point that we're sitting at. I think the last 3 to 5 years, the right place would have been to sit more defensively in fixed income and cash, and you would have comfortably earned your real return given the yields that were on offer. But given the rate cuts we've seen so far this year and another potentially 50, if not more, to come from the Reserve Bank, I think something like cash, the yields on cash sitting at less than 4%, as you mentioned, are going to struggle to beat inflation, maybe not as we sit currently with inflation sitting at 2 to 3%, but as inflation starts, we certainly expect inflation to start increasing up to 4 to 5% on a more normal basis, and cash yields are going to struggle to deliver those real returns that it has in the past. So your opportunity costs now for sitting in cash, as a conservative investor, are now going to start to become higher. And as I mentioned earlier, after these big drawdown periods, often your risk asset classes are going to start giving you very attractive investment opportunities, and the return potential over the next 12 to 24 months in these asset classes starts to look very, very attractive. And so, you know, with that high opportunity cost of sitting in cash, it almost pays the investor to start increasing their risk exposure and increasing their risk profile, simply because the returns in other asset classes are going to beat inflation very comfortably.
Okay, cool. So we got 8 minutes left. So I think it's probably a good idea to start wrapping up. I'll ask you guys for some final thoughts, and we'll do some closing. Unless there's one last question. I know we haven't got to nearly all the questions, but I suppose it's just, so apologies for that. What we might do is we'll have a look at them again. We'll share the questions with the Coronation team, and hopefully maybe that the guys can look at. Okay, here's one last question. I like this question. What's your view on the prescribed assets, Charles? I'll give that to you.
Yeah, it's a debate that's been around now for some time. Pre-COVID, it was easier to dismiss. But as the government is really going to scramble to raise enough revenue, it comes into the picture more. So far, talking to the Reserve Bank and Treasury, they're not keen on it, but it's a sort of a sign of weakness. And to date, government they've been issuing bonds and been funding it. So they've been finding enough people like the Coronations and other asset managers and pension funds to buy those bonds. If the yields are decent enough, we'll invest there. So the prescribed assets is really, you need that when you can't raise enough funds. Then you have to force the pension funds to go and buy the government bonds. That's what happened in the apartheid era. But so far, they've not struggled to get the bond placements away. So they've managed to do that, although the yields are on the high side. So we think it will be a bad sign if it happens, but given the precarious situation on the fiscus, I've changed my stance that whereas a year ago I thought, man, dat gaan nie gebeur nie, forget it, it's not going to happen. Now I think it's a far bigger risk that it does come in. Normally, it's as I say, a sign of weakness. We don't like to be forced to own anything. We want to own where we think the yields are attractive. And currently we do own some govies because we think it's okay. But if they bring in prescribed assets and we are forced to own more, what they do with that money is, to invest it, to go through a door where you can at least know you can get out the room again.
Yeah, no, it's quite a scary thought. Okay, I'm going to start wrapping up now. So Charles, just final thoughts from your side, and then I'll ask Pallavi the same thing.
Yeah, I think I've been through a few crises now. By the way, this is my last one. I don't think I've got the stomach for another crisis. But this, in many ways, has been the worst one, because something like the global financial crisis. I'm trained as an economist and in financial markets, and that one, the crisis, its origins was in the financial system, and I have a fair idea of that going to pan out. To deal with a medical crisis like this, it's for me much tougher to understand how the game ends. But this one will blow over as other crises do. There will at some point be a vaccine and or enough herd immunity, and unfortunately, many people will have died in the process. But once there's a vaccine or herd immunity or something, life will continue. So we must be sure that we are invested in the survivors and not the ones who will, fall over. And some of the survivors will be stronger because there will be less competition among global airlines. Many of them won't be there around anymore. So you want to be sure you with the survivors and not with the ones who fall over. In the SA space, for example, Pallavi mentioned, Dion and places like that may not survive. Certainly Edgar's, we know already, will not survive. But Foschini, Mr. Price, and a few others are ready to feed off the carcass of Edgar so they can come out stronger. So we must always look at a crisis at some opportunities that will come. And I think plenty of that around. And some prices, you mentioned the banks earlier. Yes, the credit loss ratios will be enormously high for this year, but somewhere out there is a recovery again, and we think a lot of that bad news is now priced in. And we always talk about the V-shaped recovery or a U-shaped recovery or whatever sort of recovery, but the market has taken a view on some of those domestic shares that there will be no recovery, and I think there will be. So there's opportunity.
Cool. Pallavi, final thoughts from your side?
Yeah, I think we're quite optimistic that, we are going to be able to have a better chance of meeting our inflation plus return hurdles on both balanced defensive and capital plus going forward than we have had in the past, simply because valuation levels have reset in some of the risk asset classes quite severely. We've already shown, the bounce back least expected from us was very strong over this last quarter. But, we look at our building blocks and how we're exposed at the moment. We have a solid anchor in terms of the yields that are available from our fixed income exposure. And you overlay that with some of the returns we're seeing in the SA equity space. I think we will remain nimble enough to take advantage of valuation opportunities as we see it. And I think we should expect further volatility, further uncertainty. But as Charles said, there will be opportunities and businesses that will come out of this crisis stronger. We just have to keep our rational hat on and take advantage of those when we see it. Thank you.
Cool. No, thanks, guys. I really do appreciate it. So I think, first of all, just a big thank you from our side to Charles and Pallavi. Really do appreciate your time and your insights. I think it's been very, very, very useful. So I really do appreciate that. To the audience, again, thanks so much for your time and your questions. I really enjoy these interactive sessions, and I'm sorry we didn't get to all the questions. It's actually just impossible to. So, but thanks for seeing them through. I think if you have any specific questions, the Coronation guys are more than happy that you contact their investment specialist, who can definitely help you out with those questions. Just quickly in closing, reminder of the CPD process. So if you've attended the entire session, then you automatically get your CPD point. If you didn't, then there's assessment you need to complete, which is sent out in the thank you mailer. The thank you mailer should come out in the next couple of days. We also will have a questionnaire, if you don't mind completing, if you've got time. And it's really important for us to get a sense of just some of the practicalities. For example, 9:30 start on a Tuesday. Does that work for you? Would you prefer it earlier or later? Obviously, we don't like to clash with any of the other kind of events in webinars in the market. Who else would you like to see in the future in these in the room series? So remember, the idea of the in the room series is that we chat to asset managers or investment professionals. So any thoughts or please shout. And then other feedback. We're happy with the criticism. Constructive criticism is good. Can make these kind of better as we go forward. And then lastly is just we got 2 webinars coming up during the month of July. So we got part 2 of our RDR webinar. Part 1 took place a couple of weeks ago, and that's with our kind of legislation expert, Jen Anderson, and hosted by Georgina Smith. So that's next week, Tuesday at 9:30. And then on the 28th of July, I'll be hosting Morningstar Investment Management for the 6th in the room series. Otherwise, I think that's it. I hope I haven't forgotten anything. No, I think I'm good. Again, Charles and Pallavi, thank you so much, and thanks so much for all the attendees. Appreciate it.
Bye-bye. Thanks.
Thank you. Bye-bye.